Welcome to another edition of the Real Estate Talk Show. My name is Simon Giannini, and today a very exciting topic, how to participate in real estate development. Now, we all know the strength of the real estate development industry, especially when we're talking about the residential condo market in Toronto, and many of you have already invested in the condo side in terms of buying a condo and waiting it out and flipping it for return, or buying a resale and tenanting the property and just riding the cash flow. We're going to talk about a unique opportunity that's really never been available before. And joining me on the line today is Greg Marchand, Managing Director with Realty Partners Limited Partnership. Greg, welcome to the call.
Well, thank you, Simon. It's good to be here.
I've got a good-looking photo of you here on this slide, and we don't have you on video, but we got a photo. And Greg, I really want to thank you. I know you're busy putting this together, and I know this is a unique opportunity. But for those of you that don't know who Greg is, let me just give you a bit of a background. Greg's with the Marchand Group of Companies since 1980, and this guy really is the guru when it comes to real estate development, construction, financing, workout, syndication, all of this, and been involved in over 50 investments with equity and financing over $1 billion. So that said, you're gonna understand a little bit better once you hear Greg describe what we're talking about, and you'll understand his area of expertise. So again, I appreciate your time here. Greg, I created a little bit of an agenda for our viewers and our listeners, and really what I want to talk about today is, number one, we're going to explain to them the opportunity with the Realty Partners Limited Partnership with the LP. And whether I'm evaluating the LP or any other opportunity, I want to know a couple things. So I want to talk a little bit about the management team, and obviously you're on the management team. I also want to talk about project returns and the residential real estate market as it relates to what we're talking about. And then for those that are interested, at the end of the call, at the end of the interview, we'll show you how you can find out more information, and we'll make it fairly straightforward. In fact, we're doing a live meeting at KPMG offices, and we'll give you all the details at the end of this interview. So, important notice here: this presentation is intended for general info and for accredited investors only. And for those that want more specific information, we'll connect you with the right people to get all of that information. But Greg, can you tell our listeners, if they don't already know, what's the definition of an accredited investor?
Well, Simon, the definition is an individual that earns either $200,000 a year or $300,000 per year with a spouse, or has investable assets of $1 million. So that's not including home. That's simply money's available to invest.
Mm-hmm. Now, one question came up. If I wanted to, for example, let's say I wanted to invest $250 with a partner, could we put that money into a corporation, and could that corporation invest as well?
The corporation, short answer is yes. Corporation can invest, provided that the principal of the corporation, or the party that owns at least 51% of it, is an accredited investor. Okay,
so the answer is yes. And for this investment type, what is the minimum investment that people should understand?
It's $250,000, growing in increments of $100 above the $250.
Okay, so really any amount above $250, and is there a maximum?
No, there isn't.
No maximum. Okay, great. So I think people should understand that the agent and the consulting firm that's been retained to work with Realty Partners is, of course, KPMG. And, of course, they're a Fortune 100 company with offices worldwide. And I think for me, as soon as I saw that, it made me feel good that we could, with confidence, recommend, not just the management team, but also KPMG. I think certainly lends an air of credibility as well. But not to belittle the management team, because we're going to talk about that. So, first and foremost, we have Hunter Milbourne. And I can tell you, I've known Hunter personally since 1986. I was just out of kindergarten at the time. No, all kidding aside, Hunter and I started working together way back in '86, and of course, the condo market was very strong in the late '80s. We had a correction in the early '90s, and we rode through that. But what you need to understand about Hunter, if you're listening in, is this guy really has defined the skyline of Toronto, because for over 30 years, he's been involved with over 500 developments. He is, by far, from beginning till today, the number one go-to source for developers when it comes to selling high-rise condos and and different facets of it. But you can also speak to, I think, Greg, if you want to speak to a little bit about his personal involvement as well.
Sure. Well, what really differentiates this opportunity from anything else that I or my family have seen over the last 40+ years is that many years ago, because of Hunter's expertise, a number of his clients, some of the biggest and most successful developers in the city, invited Hunter to participate with them in the equity investment in the project. So to become a partner. These are developers that typically only use their own money. They don't have passive partners in with them, and Hunter's there because of expertise. So Hunter's been doing this for probably over 15, 16 years now. Been involved in over 30 projects as a principal investor. And the key word here is invitation. Now, he's invited into these opportunities, and our relationship with Hunter simply is going to allow Hunter and us by extension to continue to benefit from these invitations. So that's what makes this very unusual. We're part of a club that doesn't have passive capital in it, thanks to Hunter.
Yeah, I mean it really has been for the longest time a private club, as it were, and he's been involved inside that private club, and his role, I guess, is sourcing investments for the partnership, and he has the contacts. Now we'll speak a little bit to others in the management team, and if you want to take this one on, I mean, obviously, if you're inside the industry, you know the names like Crestford and Urban Capital and Barry Lyon. What was important for you when you looked at putting together this team?
Well, two things. One, these are just a small, very small sampling of those who offer invitations to Hunter, and it should be noted these are invitations where where Hunter has been and we will be participating on an equal basis. So if we're going to be putting up by illustration 20% of the equity in a project, we'll earn 20% of the profits. And these are just a small sampling of the participants in the market today who are dominant, who do not have passive capital generally. They have their own money. You also see Barry Lyon here. Barry is one of the independent consultants that pretty much everybody in the industry goes to validate the projects they invest in. So you can see that Barry and Hunter go back a long, long way in what's happened in this city with everything to do with high-rise development.
Okay, great. Well, let's talk a little bit about an overview, as it were, and what the investment strategy is going to be. So we're talking about multi-unit residential. We're talking about development sites. We're really talking about getting in on the ground floor with some of these developments, aren't we?
Absolutely, absolutely. The kind of overarching guiding principle behind what we do is participating in value creation. Another way of saying it is we're in the manufacturing business, and the product is multi-unit housing. So we'll be doing three things in this vehicle. First is we're going to be continuing to accept those invitations that are extended to Hunter to participate at various stages of the development continuum through a project's life. Second is because of Hunter's position and knowing really well before the marketplace does where some of the major developers are going, we have the opportunity to acquire small infill properties, which infill usually means there's something on it, parking lots, small buildings, something that generates some income. And you buy it for the purpose of doing what the industry likes to call a municipal repurposing, which is nothing more than configuring the municipal registration of a property to allow for high-rise development. There's a significant value created in that process, and that'll be a part of what we do. And lastly, we're talking about being opportunistic. Opportunistic comes in many forms. One example that we can offer is our construction lenders. Very, very conservative. They remember the early 90s. And one of the things they tend to do from time to time is require developers to infuse a little bit more cash equity in projects as they go through. These are opportunities that get extended to us. So, all the way through, there are different things that happen that allow these invitations to continually be extended.
Mm-hmm. Well, what's interesting for me is, having been involved in the industry from both sides now for almost 30 years as well, we've seen a lot of investors invest on the retail end of things, as it were. In other words, the developer's gone through this whole process. They've acquired the infill site. They've done the rezoning. They've got the building permits. And now that the value has been taken from X to 2X, or from 5 million to 10 million, let's say, now investors that buy condos or end users that buy condos are in essence allowed to participate, but only on the retail end. And they've done well. So the builder is ready. They're selling. They've got the sales office up, and investors are buying units with the upside that's going to happen in 3-4 years down the road. This is an opportunity I see to get involved on the wholesale level. Greg, so again, let's talk a little bit about the management team, because I know we know about your involvement and that of Hunter Milbourne, of course, but let's talk about the structure of the management team and how individual projects will be brought into the limited partnership. So you've got the mic.
Sure. Well, the general partner is a cooperative effort between Hunter Milbourne and myself. Hunter primarily is tasked with finding the opportunities, accepting the invitations, as he has for years. My role is more the underwriting and the investment configuration, documentation, and management side of it. We have an advisory committee made up of 4 people who are, each of them being kind of industry stalwarts in their respective fields. And these are people that really the entire industry goes to from a viability perspective. Mm-hmm. We also have 2 members, 2 independent members of the investment committee. So there's 4 in total, Hunter and myself, and our 2 independents. The governance there is every new investment needs to be approved in a unanimous fashion by the investment committee. And the LP is being audited by BDO. So there's a considerable amount of typical public company type governance that is wrapped around this vehicle to protect all of our money.
Mm-hmm. Yes, sounds good to me. And if you're listening and you're wondering if you're wondering about more detail about the advisory committees and the investment committees, all of that is broken down with names and biographies on all of the people advised in all of the committees. Correct?
That's correct.
Yeah. Okay. So for those that are curious, now let's talk about the actual properties themselves. And I think it was important for me, and certainly I think anybody listening would want to know, what are some of the projects that you and your team have been involved with in the past. So let's talk a little bit about them. I know about your involvement in New Times Square, and that's where my knowledge ends. So can you talk a little bit about some of the previous projects and what the involvement was, Greg?
Sure. Well, I guess in the overall the years between Hunter and myself, we have been involved in over 600 projects in the City of Toronto. Combination as broker from Hunter's perspective, or as a principal investor, Hunter and ourselves. So we've provided a few of the projects. So as you mentioned, New Times Square, you're familiar with. Mm-hmm. St. Andrews on the Green was a project that Hunter invested in and also acted as the marketing agent for. That's an urban capital and Malibu development project. There's additional projects, the Boutique, which again, a high-rise condominium located downtown, an urban capital Malibu development. Interestingly, there's an example of why we're here, which is Hunter was offered a 15% participation in that project, and he took 6.25%, and it was simply nothing more than a matter of available funds on any given day.
Sure. Can't buy them all.
724 Shepherd Avenue is a project that Hunter was involved in with Saul Wassermuhle of Page & Steele, a renowned architectural firm. Mm-hmm. There's a prime example of the municipal repurposing. So a small property that was purchased, Saul and his team moved it through the municipal side, and monies were doubled in a relatively short period of time on that one. Mm-hmm. And we can go on and on. There's some bigger ones, Imperial Plaza, Camross Felcorp. That's the former Imperial Oil building. Project, yeah. Very exciting. You look at the size and the magnitude of that. The conversion of the existing building. There'll be 2 additional new towers that'll be built behind that. Again, another perfect example of what happens when a very big developer takes on a premier project. They reach out to other fellow developers, and if you were able to see the participants on the equity side in that transaction, it's the veritable who's who of the development industry. So again, key developers who only like to partner with other developers. It's expertise. So great example there.
And of course,
21 Avenue
Plaza,
Road.
yeah.
Same thing. The same story basically applies to that one. It's Camross Velcorp, and the partners in that project, again, are those names that we all know, but really never get to participate with in this fashion.
So this is an opportunity to get involved in these very exciting projects, and exciting aside, they're also proven to be and continue to be very profitable projects. Otherwise, these builders are not interested in doing these things, and I think you said it. It gives us an opportunity to invest on what the lawyers would call a pari passu basis, which means equal footing, and getting in on the ground floor. And it really does give us, obviously Liberty Village, most people are aware of, the Regency Yorkville, and let's shift gears and go forward now. So the initial properties here, if you want to just talk a little bit about them right now, Nicholas Residences, etc.
Right. These are all going concern projects that are underway right now. They're at various stages of completion. They're all sold either to the 90% up level. Sterling might be the one exception. It just reached a 70% sales level. The note there is Hunter has yet to formally open the sales center. So just to friends and family, that conversion of the existing building has reached its pre-sale level for construction. There is one footnote that I think is really worth sharing with respect to Sterling, because of all of what's being rolled in, and we can talk in a minute about how we came up to these five in particular, is the Sterling really, in order to return our capital and provide us with a return, it resides on the conversion of an existing building, just mentioned, 70% sold, and a small 26-unit townhouse project that sits right next to the existing building. The exciting part is there's also, the Sterling sits on an 8-acre parcel. So there's additional square footage to be built as we go into the future that will exceed 1 million square feet. So, in short, in about 24 months, once we get our capital back and a return from the existing two properties with no money invested, we're all going to be participating in the development of the balance of that property, which arguably could be worth at least $40 million today, just the land side. So that's a very, very exciting aspect of that one. The real purpose in configuring these is these projects represent Hunter's co-investment in the vehicle. So what Hunter's doing is he's taking the money that he has invested in these projects, and he's putting these projects inside the limited partnership in exchange for limited partnership interests. So he will be a partner just like everybody else. These projects represent his contribution, and the key is these are projects that are designed and scheduled to start to pay out or monetize in each of the next 3 years. So each of these not only represents a well-advanced project, but we're looking at a page that shows us, at a minimum, where our distributions are going to come from, back to all of us over the first 3 years. So those were the kind of the key criteria behind selecting these specific assets.
Okay. Well, let's talk. Let's move on then and talk about project returns. And I'm on the slide talking about distribution of total return. So can you just walk us through this a little bit?
Sure. What this slide is showing is really the sources of money that are used to create one of these large projects. And what you'll see is about 60 to 70% of the money will come from construction financing. So banks will typically lend to a very capable developer about 70% of the cost to build the project.
Now, we're not talking about the cost of the land, just the cost of construction.
Cost of construction, that's correct.
So the developers already put in the money for the land, and if they can, they will. So they go to the banks, so they get construction financing, and that accounts for 60, 70% of the money. So they have to get the balance of that money where?
Correct. The balance of the money is really split into two sources. One will be the purchaser deposits, the deposits that all buyers provide when they buy the units. And the balance is the money that the developer actually has to put up. So it's the developer's cash, or sometimes what you hear people refer to as the cash component of the overall equity for the project. Mm-hmm. That's the money the developer has to contribute.
So in essence, we're involved right here in helping cover the cost or the cash component of the construction of the project over and above the financing of the developer, financing by the bank rather.
That's correct.
And let's move on then and talk about capitalization. And so walk us through that. Here's an example of a residential project, and let's understand, how is our money invested and what's the equity contribution and so on.
Right. Well, again, what this slide shows, you'll see three columns, and the one number that changes as we go across from left to right. You'll see being the third line down, or second line down, sorry, being land. You'll see it sitting at $20 going to, or 20%, 10%, 5%. And what that is showing is the value that is created by the municipal repurposing process by changing the ability to construct on a property. So the 20% figure, 20% of the overall, that's what we call kind of the retail value of the land. So if a builder is buying a property where all of the municipal aspects are in place, that's the number or the percentage that typically is apportioned to the land or the base property. So as you go through the equation, what you see is over an average investment period or build period of 4 years, the internal rate of return on the cash that gets invested is about 28%. So that's what we like to call the build margin. So if somebody else has earned all of the profit on the land and the value creation, and all you want to do is build it, that's the average return that is seen today. Mm-hmm. The two other columns really are generally speaking, the two other extremes to which you see. I don't think I've seen anything where land would be less than 5%. That's a pretty successful. 10 is a pretty conservative and highly attainable. So you can see that what happens is if we look at optimal value creation, the internal rates of return on these kinds of projects can be as high as 65% in the overall. So looking at this, it's not uncommon to see the value of the base property increased by 2 or 3 times through the municipal purpose. When we add to that the money that is made when you sell and build one of these projects, put those two together over an average timeline, these are the returns. So when we think of the slide prior, when we talked about, the developer has to put up 20% of the overall capitalization of the cash equity, when Hunter invests and when we invest on that pari passu or equal basis, these are the returns that we will earn. What you do see in the marketplace from time to time is what we'll call the retail syndication of these kinds of projects. And what that typically means is the passive investor will put up a disproportional amount of the cash equity. So simply said, 90% of the cash equity for 50% of the profits. You will see some of those transactions being circulated, but that's the fee, if you will, or the cost that the developers, those developers who do those kinds of things, that's what they want. That's the disproportionate part of the profit they want for letting passive investors in. So it's a sizable difference.
So our example is a little different. Obviously, the advantage for us and for the developers is getting in as early as possible in the stage before the site is repurposed or the zoning is changed, as it were. So let's talk about distribution. Our money's invested, and the investments proceed. So you want to talk about that now?
Sure. The way money will flow back when a project is completed and pays out is the investors will first receive the return of 100% of their subscription proceeds. Secondly, they'll receive an amount of money that equals an 8% per annum compounded return. So we call that the preferred return. The next block of money will be shared 80% by the limited partners and 20% by the manager. The manager is Hunter Milbourne and myself. There's a further withholding on the money that goes to the manager. And what happens there is 40% of anything and everything that goes to the manager is held by the limited partnership in trust until the very last project is finished, completed, and we're ready to wind it up. It's just a reserve against the absolute unknown. So that's something that KPMG and Hunter and I wanted to do to ensure that extra buffer for the who knows what.
Just extra safety. So at the risk of being redundant, I get all my money back first, then I get my 8% return, and then the profits are split 80% to the investors and 20% to the manager.
That's correct.
Which seems reasonable because the managers are the ones that are bringing the deals to the table. So,
and
all of this is overseen by BDO, and the agent, of course, is KPMG.
Correct.
And what kind of reporting, I guess, is provided to the partners? That's one thing we haven't really talked about.
Minimally, at a minimum, what will happen is there will be a quarterly report that speaks to all investments, how they're performing, what we're looking at, market commentary on a sub-market and macro basis. On an annual basis, there will be audited financial statements that come out. There will be what's referred to as a T5013, so anything that you need for your income tax filing, that will come out at the end of the year as well. So that's the formal side of it. The informal is really all of the sharing of information on a regular basis, which could be in some cases weekly, monthly. So whenever there's something interesting, topical, exciting, a transaction that's being looked at or concluded, all of that will be reported in as close to real time as humanly possible.
Okay, great. Now, the question that I always get, and I'm sure you do as well, is hindsight's 20/20. I wish we would have done this 10 years ago. Is this the right time to do this? And we can talk for a minute. I think most of the people have a good idea what's going on in the market, but let's just recap a couple of things. Number one, the Canadian economy is on a solid footing. In fact, the rest of the world seems to be scratching their head and looking at what we're doing to figure out what we're doing right. And the fact is, we have a growing population, and the projection, I think, is, according to Stats Canada, that 1 million more people will be in the GTA alone in the next 10 to 12 years. And of course, they need to live somewhere. But this is something that a lot of people are unaware of about the Toronto area, and that, of course, is the Greenbelt. And what we literally have here is, when I see this visual, I literally see almost like a real estate island, because the Greenbelt around the city of Toronto has created a situation where we can't develop any further north or west or east, and we can't develop south because there's something called a lake, and it really is landlocking the GTA. And this is what's creating the high density, and what is of course created the biggest condominium market in North America and the second condo market in the world. And people are wondering, when will this end? And the fact is, it really can't end, because that's where we are. If you want to just give your comments on that, Greg.
Well, you're absolutely correct. A couple of observations. First is from a value creation perspective, the ability to get density. Arguably today, I believe that the profit to be earned in this entire process is greater than it was 10, 12 years ago. The projects we did 10 years ago, we did not see density or the ability to put volume. It was harder to get then versus now. It was at the beginning of this whole urbanization move. So value creation is really at its optimal level now as you look over the last 10, 12 years. And you're quite right. The low-rise developers are now doing about half the volume that they did 5 years ago. So their ability to contribute to that historical 40,000 homes a year is now declining to beneath half of that. And the other important aspect that seldom you see commented on is the ability to construct, the ability to build and produce all of these projects. We probably in Toronto, again, arguably have the best construction techniques and some of the best builders in the world. But they still, notwithstanding their size, they can still only build around or approximately 18,000 units a year. Mm-hmm. So what happened last year is an example, a record year in sales. The approximately 28,000 in the high-rise side. Conventional wisdom says not all of those buildings are going to be built, which simply demonstrates we have a marketplace where we have really more buyers and more users than we have the ability to create product. So I think the economists would say those are good trend lines.
Mm-hmm. Yeah, I mean, one of the figures we hear from, I believe it was RealNet, is that the projected demand in 7 to 10 years is going to be 40,000 units a year. And you just said it. We just had a record high sales of 28,000. So we're not even near the projected demand. And if people are wondering who's going to buy all these condos, I think the real question people need to ask is who bought all these condos, because most people are unaware. When a project is up, it's already sold. It's already 70 or 80% or 90% sold. And we're seeing growing and growing numbers of end users. Of course, investors are filling the void by replacing the lack of rental housing. And of course, I think we're sitting at 1.2 or 1.3 vacancy in key areas. So the demand is there for housing. And I can't agree more. This really is the right time. But let's talk very briefly about the inventories and pricing. Very briefly, because we want to just get people to the next step, which is how do they find out more. But let's speak to this for just a quick second.
Right. Well, again, just by extension, we're talking about the ability to create supply is trending down. These numbers are decreasing. The demand for accommodation, and just a footnote to all this, when all this started 10, 12 years ago with the current official plan, or the then new official plan for the City of Toronto, Toronto made it crystal clear in that plan that the creation of new rental accommodation, residential rental, was absolutely going to reside almost exclusively within condominium buildings for the simple purpose that condominium buildings by law have to be maintained. So they don't want any new rental stock being built that will be problematic 10, 15, 20 years from now. So when we talk about the demand, we're talking about the demand from a rental perspective and from an owner-occupant perspective. So the other item or number that I think is very telling today is the difference, the average difference between a high-rise condominium and a municipal or urban home, rural home. A number of years ago, 5 years ago, was around 70,000, and today it's around 170,000 approximate. So the spread in the cost of and the value of the product is clearly moving to demonstrate and support that notion of as far as the single-family home world goes. The supply is absolutely diminishing to the point where we see this massive delta or difference between the two values.
So economics 101.
Exactly.
Yeah, economics 101. So that said, I'm sure for those listeners that want more information, we're going to actually make it very, very easy. We're holding a special meeting on Thursday, October 25th at KPMG offices in downtown on 33 Bay, if memory serves.
333 Bay.
333 Bay. And it's by invitation only. To RSVP, simply send us an email to info@reccanada.com. If you cannot make that time and day, or if you're listening to this interview after the day, fire us an email. Tell us you want more information. We will connect you with Greg Marchand and the people at KPMG, get you all of the information. And if this investment is for you, fantastic. We couldn't recommend it more. We hope this interview was informative for you. And again, I'm sure you've got a lot of questions. Just fire them all away, and we'll get all the questions answered, again, by the right people at the right time. But hopefully you can join us on Thursday, October 25th. In fact, Greg, you'll be there. Hunter Milbourne, I understand, will be there as well.
Absolutely.
As well as some key people from KPMG and others. So that's the place to get all the information. And we hope to see you there. And this is Simon Giannini with the Real Estate Talk Show, talking about how to partner with real estate investors. And thanks again to Greg Marchand. Greg, thank you so much for being on the call today.
Thank you, Simon.